Okay, so we're back. I'm back. Tom's back. China's back. Vol's back. Bears, bulls, dopamine. Everything is back. It's time to reflect once more. And so when I'm confused, I call a friend, and I'm very glad. Tom Roderick. Tom is portfolio manager at Trium in London, managing macro. And most Tom, who I thought about, given this week's reverberations around the Chinese property market. Tom, thank you very much for accepting.
No, good to be here with you as usual.
Back in my hedge fund days with Eclectic, I think it was 2011, we launched a kind of one-off dedicated fund, which was predicated on China. Actually, it was predicated on the ability to buy remarkably low and convex volatility at very cheap levels.
Yeah, well, I think with these trades, it's always about trying to find out where the leverage is and trying to work out cheap ways to get exposure to that leverage unwinding. And I think it brings us to today, where arguably the biggest leverage in China is in the property sector onshore. You have significant amounts of incomplete properties. You have a huge amount of empty properties in China, which is sort of owned by investors. You have a Chinese government which is essentially trying to reorientate society and its own capitalistic system to bring it down. They put together these 3 red lines that all property companies have to abide by, which essentially just manage leverage. And if they fail those 3 red lines, they just don't. They're banned from borrowing any extra money, and are forced to sell off assets to repay their liabilities.
But there you are, and you are a professional macro portfolio manager sitting in London. Wasn't that just a great invitation to come out and short these things?
Yeah, and I think it was, but the perception is that the Chinese government can do no wrong, and they essentially decide what happens. If they want one property developer to go bust and not the system as a whole, then that's what will happen.
But I'm not aware of it becoming a big macro trade.
Well, you look at the currency. The Chinese yuan has essentially appreciated this year. You look at SH Comp, which is the composite of the Shanghai Stock Exchange. That's up on the year.
It's a CCP approved index in that it, free jack. It doesn't have Alibaba and Tencent et al., which is why it's up on the year.
Yeah, and you can argue in a way that the fact that index is still up on the year, the fact that there's been no pressure on the currency, allows the Chinese authorities to kind of cause more pain on the system.
I'll have my friends in financial media, the FT, the Wall Street Journal, and they'll be, hey, the Shanghai Comp's up on the year, and it's like, so, I'm not vulnerable, because typically what happens when a sovereign starts these cultural revolutions, these revolutions against capitalism, typically they can be, depending on the scale of foreign investment, if it is large, and it is large in China, people start going, hey, you didn't tell me about this when I was putting $1 billion into the country. I think I'm going to go home, right? And so they've quelled that form of nervousness so far by having this contrived stock market index. They have quelled it via what they can do in the most preposterously named institution, SAFE, the organization that's part of the central bank, which effectively paints the tape on the currency. $1 is red cabbage to a Chinaman, I don't mean that in a pejorative sense, what are you going to do with dollars in Beijing? You need local currency. And so it is natural for the banking system to return the dollar bounty from the overseas trade back to the central bank, and then the central bank buys US treasuries. It doesn't buy US treasuries because it's a hedge fund and it thinks yields are going to fall. It does so because it's painting the tape. It has favored the political ideology to have the renminbi be strong against the strongest currency in the world this year. Can it continue, however? Can it continue?
Well, I think one of the reasons it's been so strong is because, we've all had periods at home due to COVID, and as a result, we can't consume services as much, and we've had to consume goods instead. China's a big goods exporter, and so I think their current account has been massively elevated by this Western desire for goods, and so they have had a lot more capital, a lot more current account flows into the yuan than they would do in normal times. You'd expect that to reverse. They've almost had an insurance policy underwritten by the rest of the world in terms of the increased goods flow over the last 18 months, which is something that's going to reverse. And so, perhaps as that reverses, and particularly as the crisis in the Chinese property sector comes to light more in the West, we could see the yuan depreciate once more.
Yeah, but I get that, Tom. I mean, that is analytical, proper analytical conjecture of movements in foreign exchange.
The reason is, another kind of just analysis reason is the difference in interest rates. Like China, unlike the West, didn't change its fiscal policy as a result of coronavirus, and it didn't change its monetary policy either. US slash rates to zero. Chinese rates are still way, way higher. And so, the carry that you get from being long the yuan is pretty decent. And so it's kind of, not only have you had appreciation, you've had carry on top of it. And so that's kind of, I think, prevented Western speculators from, just selling it like they did before. And interest rates at 2% higher than the rest of the world. Everyone else is fighting to reduce interest rates as much as possible. And I think with the Evergrande thing, if they don't rescue the individual bits which are causing the problem, and they allow sort of fear to spread around the system, they need to spend more money eventually via monetary policy, via triple R cuts and rate cuts than it would cost them to bail out the individual bits of Evergrande which are struggling. And so I think, that monetary policy differential between the US and China will probably come down. And with it, I think the yuan will start to sell off.
Yeah, and they've been cutting the reserve, the triple R, which is the amount of capital banks have to hold back. I think today is about 12% or 11.
Yeah, that's right. So it came down, like in 2011 it was 21.5 throughout, and I think this is an illustration about how Chinese monetary policy was quite tight over the coronavirus period. In the entirety of 2020, they left it at 12.5%. It's only in July this year that they actually finally cut it to 12%. So, so the entirety of 2020, they didn't touch the triple R. They didn't touch rates and they didn't touch the triple R. I'd say, at least if you compare their reaction to everyone else in the world, seems pretty tight monetary policy to me.
Yeah, except on the ground and looking at the increase in leverage that the system actually has, it's like everything else, mousetraps or whatever. They've got this bank system which doesn't really work, and it is, the transmission for credit is elsewhere. It's in the $9 trillion of local government financing vehicles. It's in wealth management products, etc. Banks lending money to each other on the basis of collateral. If, because of the machinations of the sovereign, you begin to undermine the willingness and the robustness of that domestic collateral that banks and speculators are passing between themselves, you could take the RRR to zero, and actually it wouldn't change if the animal spirits had suddenly reverted to fear and concern.
No, I definitely hear you on that. I think property, if you look in the US, and I think I had a chart on this. I don't know if you can share it, Hugh. But if you look at China, like the percentage of wealth which is in property is something like 4 times higher relative to stocks than it is in the US. And so, like this is the if you're talking about wealth, if you're talking about collateral, property is collateral in China. If you're an investor, most of your net worth is in property. That's not the case elsewhere in the world. But, the point essentially is that Chinese collateral is property, and so the Chinese system is far, far more reliant on property than any other part of the world. And I think another thing which is interesting about the way that the Chinese property sector works is that compared to a lot of the rest of the world, it's actually a really great business model. So, here in the UK, property developers will start, they'll buy the land, they'll start a project. They may get an initial deposit from potential homeowners of say 5-10%. Then they finish the property. Then they get the rest of the money from a combination of the property purchaser and potentially a mortgage from the bank. In China, a project can be like 2 or 3 years from completion. They get that initial deposit in the same way, but instead of having to wait until the property is completed, within months, the property purchaser gets a mortgage from the bank, puts down the rest of their deposit, and pays it directly to the property company. So the property company offloads its risk to the banking sector and to the homeowner almost immediately, like way, way before the property is actually completed. And so when you talk about the property industry in China, it's like as a business to be in, it's about 1 million times better than anywhere else in the world, simply because they can very quickly offload their risk to other sectors of the economy. And the fact that we've got to the point in this beautiful system to be a property developer, to the point of bankruptcy, suggests the scale of the problem. Because a bankruptcy in the property sector in any other country would come to a head way, way quicker, because the property developer has to take on way more risk. And so you've got this great system to be a property developer, and yet we've still got to the point of bankruptcy. So what Evergrande has done is just, they bid up the land, they turn over that property to other people very, very quickly. In a way, I guess you could argue as a bit reminiscent of CDOs in the US pre-2008, whereby the banks who were issuing the mortgage to the client didn't really worry too much about the credit risk or about the ultimate value of the property, because they could just dump it and just like distribute that risk into a CDO straight away, such that they didn't have to worry too much about that risk. And so I think that's the problem in Chinese property. The property developers have never had to worry about the land value or about the true value of the property, because they just offload it straight away. And my guess is that China thinks that they can just, ring fence Evergrande and not cause any other issues for the rest of the economy. If that was a property developer elsewhere in the world, that may be true. In China, that's probably not true, because Evergrande is the tip of the iceberg, even when it comes to losses on its own property and on its own balance sheet.
Yeah, for sure. I always want to come back and quote my good friend, the German philosopher Gustav Fechner, whoever he is. But he had that great thing that he postulated that to have a series to create an arithmetical expansion in a series requires almost a geometric expansion in the underlying source. And a bit like Steinbeck, the monster has to grow, and that just, that arithmetical progression, the stimulus having to be so geometrical, that's being Chinese GDP growth. It requires this geometrical intensity of credit, and it has to occur invisibly in these dark clouds of other financing. I remember we wrote a paper at Eclectica, I want to say in 2011 or 2012. And I have to admit, kind of talking about all of these themes back then, 10 years ago, the themes seem to be kind of very similar. All that's changed is we've become older. The absolute debt to GDP ratios have gone higher, but nothing seems to have its comeuppance. But back in 2012, we were looking at Chinese shipping companies. And of course, it's all about float. You talk about the property model, and the shipping model was something similar. You get advance payments to start building the thing, and these guys would put it into special financing vehicles, which would go into property. So it does have that ability to come unstuck. And
it's kind of like, why now? Like all of these ratios of risk have been high and have just continued to trend higher, and the collapse has not come. And so that's the real question I think we have to answer is why should, if 300% debt to GDP is fine, why isn't 400%? Why isn't 500%? Like, I think the difference is that in the rest of the world, in Japan, in the US, to a certain extent in Europe, monetary and fiscal policy is to some extent held captive by capital. And if capital starts to scream in pain, ultimately policy shifts to alleviate that pain. Whereas I think the difference in China, and I think this wasn't the case 5 years ago, and has become progressively more the case under Z, is that capital doesn't call the shots anymore, and like the kind of the strength of capital as a power base is a competitor to power in China, and doesn't it doesn't get to dictate policy in the same way as it did in the past and as it does in the West. And so, because that phrase, the monster either grows or it dies, it's true to an extent, but you've seen this in other states as well. If you have a very, very embedded regime which cannot deliver growth and kind of starts to recognize that it can't deliver growth, it can either just kind of keep on pushing and trying to create that growth, or the alternative is it basically starts to repress its people more and subjugates them such that it relies on fear. The sum of growth plus fear has to be enough to sustain the system. But I think what we're seeing is an increased reliance on fear because the growth isn't there.
Well, I think that is it, Tom. That one-off incredible move from peasantry to the metropole kind of was at its zenith, concluding around about 2010 or so. And that's when we were writing writing those papers. 2010 was the time to say that event was over, and to soften the market up for lower GDP growth. And that would be no bad thing, but they kind of got caught up and refused to do that. And so they found themselves falling back on immense risk capital appetite domestically onshore, and property was how they did it. Again, the 9 trillion of local government financing vehicles, which was on the basis of selling land, but that created 9 trillion, which then went into high-speed rail and all these amazing infrastructure projects, and that was your next 10 years of GDP growth. Global risk would have bid renminbi to 5, if not 4, were it not for the Chinese PBOC purchasing $3.5 trillion of US treasury bills, right? What is that equation? They are selling renminbi and they're buying dollars, right? So they are offsetting the private risk, the global private risk appetite to appreciate the currency. It was a public policy.
In fact, but the Japanese did that to a certain extent as well, right? I guess maybe not to the same scale, but.
Yeah. So Tom, I'm sharing. I believe I'm sharing the dollar CNH rate. So this is the end of 14. Okay. And the level is 6. Okay, so that is the end of the great sharp ratio trade, the zero volatility and renminbi appreciation. And appreciation, is to 6. And you were very good at seeing how that was becoming very hard to continue as a trade, and then it reversed. And then somewhere around about here in 15, my very dear friend Kyle Bass came out with his special purpose vehicles, which were essentially buying like 9 strikes. So 9's not even on this chart. The high tick on this chart is 720. So 9 is off my chart somewhere up here. And it was a great time to launch that, because you see the currency, like I said, from the beginning of 14, actually the dollar appreciated, which is, say, the renminbi devalued is not the right word, but it lost a full point. And so bets against the renminbi got bigger and bigger and bigger as Kyle et al. Pounded the table saying property, leverage, collateral, everything we're saying today, this thing's going to blow. And again, with you at my side and the team, we were saying, hey, listen, there's no way in the context of 2016 that the CNH can trade 9.5 or 10, right? That would create a Mad Max world. This currency is profoundly undervalued. This currency is this sovereign nation is producing $3 trillion of exports because it's so undervalued, and you want to devalue it from 6 to the best part of 10. What are you smoking? So I was at weak to that degree, and again, people would say, well, but back then you said 9.5 would be a Mad Max world. Why can it not trade at 9 now without creating this Mad Max world? Let's discuss that.
So my view was that the trend that you showed the end of in 2013. If you look at the onshore, you can see that trend going for much longer. That kind of managed crawling peg at a very, very low vol level encouraged everyone to just be leveraged long into the yuan. Foreign capital couldn't necessarily access onshore Chinese investments, but what they could do is massively leverage into this crawling yuan appreciation at a very, very low volatility versus the US dollar. And I think, when you have this leverage build and build and build on top of a base of very, very low volatility, it doesn't take that much to sort of cause the whole thing to reverse. People have used the wrong vol number in their risk calculation. They've got too much. Everyone had too much size. And so I think the question is not really what caused it to blow. If it wasn't one thing, it would have been another. It was destined to blow at some point.
So this whole movement that we see here, which is renminbi weakness, had nothing really to do with the domestic internal analysis of credit or asset markets. This move here, like you say, we're only showing 1 year, but that had 3 or 4 years, and that was premised on the wrong vol assumptions, and so risk capital had to adjust, which is to say they had to reduce the scale of the bet, and reducing the scale of the bet created this counter trend weakness in the currency, which took us all the way to 16, and then the currency began to appreciate again. So thank you for reminding me that, Tom.
And it was that froth. It was like, I think it was something like $1.3 trillion of leverage in that renminbi backed by dollar borrowing. And it was the profound losses which would have to be created on that enormous amount of leverage, which was why it would cause a Mad Max world in 2014 if dollar CNH went to 9. Like, that leverage is not there anymore. And so I think you can say that, the risk is less. The tail risk of where the renminbi trades is no longer there in the same way as it was back in 2014 to 2016.
So, Tom, what about I think we addressed this. I addressed it by using too many words. You addressed it properly. This was the Sharpe ratio trade orchestrated by the central bank, which became preposterously large. And then as risk revealed itself, it was reduced in size, and therefore the renminbi mean reverted back to its trend of appreciation. But it never appreciated to the same degree. Okay, you would say, yes, because when it traded here, which is like 6, this is the CNY, this was really not a true price because it was predicated on the wrong risk model. But 7 years have now passed, and the Chinese currency, despite the fact that it's doing $3.5 trillion of global exports, is unable to test. Do you think is there something that should be dismissed as really an anomaly, that 6 print? And I want to say the 7-8 years subsequent years where the currency has been unable to make new highs vis-a-vis the dollar, and even here this great show of strength in the renminbi, and again from I guess the current account consequences of COVID and their early reopening and shortages, etc. And yet, so this is really, you could argue, the best of conditions for the Chinese model, and it still didn't take out previous highs. Is that chart changing? Because chart-wise, I'm beginning to go, I used to think the sum of all probabilities was that dollar CNY over the course of the next 20 years, in the status quo, if you will, which is to say avoiding 1 in 100 year type, domestic credit blow-ups, would trade 5. And now I'm like, I don't feel comfortable with the notion of 5, because I gave everything the test of time, and I think 7-8 years is a long time, and it can't break 6. So what do you say to that?
I think this chart is a great way to show how over the long term almost everything is macro, because you had that huge appreciation as you spoke about, then you had the huge buildup of leverage which came off between 2014 and 2016, and then you had the rally again, where China was doing very well, until Trump came out and was basically like, China is a cheat. We refuse to accept the Chinese model of doing business, and we want to take them down. And in some the oddity is that to stop China being mercantilist actually made their currency sell off, and arguably allowed them to be more mercantilist, which is a bit of a paradox, really.
Because again, as you preface really well, everything is macro. This was an incredible mechanism for, again, Fechner, right? The arithmetical progression in GDP at a level between 7 and 10% every single year requires a geometrical stimulus. The stimulus was geometrical as we took peasants to the metropolis, right? That ended, and the arithmetic progression in GDP was suddenly at risk, and that was met by this funding mechanism, which meant essentially you could borrow in dollars at zero, and you could bring it on shore, and you could invest in a property or a special vehicle, like our shipbuilding friends we alluded to, at 15%. And the currency went up, which meant that when you went to repay your outstanding loans, you repaid like 10% less. And so that whole progression here created a geometrical stimulus, which allowed Chinese GDP to go 10, 10, 10, 10, 10, 10, 10. Yeah. So everything is macro. Yeah. And again, it's this, what happens with, they're just going to mess with the geometrical stimulus. That's where we're coming to.
The question is whether internal leverage within China has now built up to the extent at which it needs to come off. And I think, much like in 2014, when there was initial attempts to sort of inject some more volatility into the yuan as a policy decision. And I think they weren't really aware of just how much leverage there was, and just injected a bit more volatility into it, just caused absolute carnage, which didn't really end for 2 years. They're kind of trying to do the same thing right now with leverage in property, and they're just trying to sort of impose a bit of discipline on it, inject a bit of volatility into what is, into that brilliant business model of Chinese property. With the expectation that they can do it and it's fine. Now, the question is that actually the case?
Yeah. So the thing I should have asked, like hours ago, is how do we, is there a trade? Now, like people say, yeah, of course there's a trade, but in the world of macro, it's all about, hey, is there something which I can put on and I don't fear really the consequences of being wrong? That it's kind of it doesn't have the dopamine of the headlines of Evergrande. It's just something which kind of looks the wrong price, and so the status quo is it just stays the wrong price and it's a boring trade. The convexity is people turn around and say that's the wrong price, and they start to reprice it in your favor as the owner of that risk. Is there? That you are gainfully employed to seek out these kind of trades. Are you finding anything? Where are you there in that process of trade and risk discovery?
Well, I think interest rates is the first one. I think the solution to this eventually will be, liquidity.
Interest rates are never the solution, but anyway, okay.
Well, okay. An attempt will be made around liquidity and rates to solve this. If that attempt is made early or late, rates should still do quite well, I think. Yeah. So if we look at the bond curve, I think because China is, it is still closed in terms of its capital, and there's huge amounts of money in wealth management products in property as well. Like you can ask yourself the question, okay, so you can say, fine, everything sells off within China, but where did the money flows go?
You're right, but I think the route is a little bit different. Those who provide you credit have been happy to accept property and pieces of paper around property as collateral. And so you can post that as collateral and receive new funding to keep going and to keep leveraging, right? And we're in the throes now where when the collateral window is opened at the start of each new day, the Chinese banks are going, the property thing doesn't cut it with me now. What else have you got? which is because property was their US Treasury. Get any US Treasuries? Yeah, okay. How much do you want? You need a yard of credit? No problem. Deposit me the Treasuries. In China, that was you want a billion renminbi? Yeah, hit me with property collateral. That's changing, and so I think in favor of what you're about to say, but that conversation now is like, nah, and they go, equities, get out of here. What are you talking about? And they say, have you got any sovereign debt? Liquid and sovereign, it's the government. And they go, oh yeah, okay. And so then you create, to my mind, the bull market in US treasuries has been a function of the banks needing that collateral and therefore being in the market, bidding up and making sure that they have physical that they can pass into the collateral window and then receive credit to then go on and do their, to do their geometrical stimulus. So I think what we're coming to is there's going to be a rush for the credit providers within the Chinese system now to replace property collateral with sovereign collateral, and that's going to have explosive price implications on the upside for Chinese sovereign kind of paper. Am I half right, half wrong?
I'd say you're absolutely right. Like I completely agree with that. Like I think as the power center kind of moves from local government / property to the central government, you need to that should bid up the cost of central government collateral versus local government collateral. And central government collateral is basically sovereign bonds, right? Like that's really the only form of sovereign collateral. And so they're basically telling you, if you think that there's a centralization of power within China, you should be buying Chinese bonds. If this was the case, if this kind of issue was happening in the West and there weren't rate cuts being passed through the system, you would see the bond curve invert, right?
Yeah. That
so far hasn't happened, but I think
so. Explain invert, because we do get some great people who might not quite get that.
So generally speaking, when investors in the West are fearful of bad things happening, they will all pile into longer term sovereign debt under the expectation that interest rates will gradually come down, and just because they know that will always be good collateral. And so you've got in the US, you've got the Fed at the short term dictating what the interest rate is, and you've got the market in the back end dictating what they think the interest rate ought to be over time, and what the Fed will be forced to do, as currently doesn't really exist within China. Bond curves are always really quite flat, but people so far have not been pushed into sovereign credit. And I think to some extent this still shows the persistent risk appetite in China of using property as collateral. The system has not shifted away from using property as collateral to using government paper as collateral. And I would argue Z will win, and winning is a curve inversion of Chinese bonds and a shift away from property as collateral towards sovereign bonds.
Are you saying we have that? Is that the situation now? What is the curve?
The curve is just completely flat, and it's
flat.
It's slightly upward sloping. So longer term rates are slightly above shorter term rates.
And when at 5-year rates, I think I want to say are 2.5%.
So if you look at in the bond market, 10-year rate to the 10-year sovereign bonds trades about 2.9%. The 5-year trades at 2.7%. 2-year trades at 2.5%.
Okay, there you go. Okay.
They generally just go up and down as one. There's just very little differentiation in the curve. And I think that's partly because you haven't needed the rate response in China like you have in the West, where you have an aggressive rate cutting cycle as a policy tool when bad things happen. And that's because the nature of the system has been different. Like property has maintained its value as collateral.
Of course.
In terms of how you want to caveat it, I think it depends on your views of the rest of the world as well. So, like for me personally, I think that rates in the US ought to go higher to be paid US versus receive China. That's kind of like that sort of like hedges your sort of global rates beta, but it requires you to have a certain view on what you think is going to happen in the US. So that's one thing you can do. I think another thing you can do is go long dollar versus CNH.
What about, Tom, what is the pricing of a 7.5 strike dollar?
Yeah, it's not that high. It's not that high. They're not that expensive right now. Like the sort of the bidding up of higher strike calls is not an issue right now. And and partially that is just because that the leverage bubble doesn't exist in the currency anymore, and so there's not this. It's not like dollar CNH goes up by a couple of points and a lot of speculators are forced out their position, which sends it higher. That's not really the case anymore, and so it's like you would imagine that a move in dollar CNH this time would be a lot more orderly, which means that the volatility is likely to be lower and option costs are not as high. So it's not expensive to position yourself in these things, and also it's just because the appetite for foreign speculators to wager against China is much reduced, quite simply because
they've been burnt.
It's been a good trade.
Yeah. And actually, that we should have said it right at the beginning. Why we're intrigued about China macro today, and why we're trying to imagine why it could develop differently from my papers in 2011-12, my papers in 2014-15, is that back then, if these events were happening, I mean, we haven't even mentioned the godfather of solo, the godfather of macro, George. I mean, George is out going, guys, it's going to blow. It's blow. And everyone's like, oh, you're boring me. Like, no one cares. No one cares. We're in a manner that is perplexing, but makes you want to engage. Like, now feels like a fun time because no one really cares.
Yeah, so, it's true. People worry more about Alibaba and Tencent, and it's like ramifications for what will happen in Western tech.
You say they care, Tom? They're too busy kind of buying Chinese tech for the bounce. They're rather saying, hey, this fascist regime has just busted me. I am a rational person. I do not buy state-owned enterprises quoted on the stock market. Why is that rational? It's rational because I can show you a chart of the SH comp, the thing which is up modestly on the year, but the downside is it is the same level as it was in 2004, right? GDP growth comes in China at the expense of wealth creation, unless you happen to have one of these winner-takes-all social platforms, and they just said, you know what, boom, that's not allowed. Yeah. So, anyway. So, but actually, you make it, I think you do a very good service in pointing out that that currency is a valid expression of what we're talking about. However, out of the deep out of the money high strikes like 9 are not the way to go forward. What we're talking about conceivably is that from these levels of 660 or so in the dollar CNY, we could envisage a kind of low vol grind higher in the dollar versus the renminbi. And so, yes, options are not expensive, but better played with kind of at them like close to money strikes if you're going to take options.
Yeah. And you don't need to you you don't need to buy a 9 strike when probably a 7 strike today costs you as much as a 9 strike would have cost you back in 2015 when the currency was trading at much the same level. So
6 to 7.
Yeah, like, risk reward, you'd probably done better in the 9 strikes than in the 7 strikes back then. But that was partially because the 7 strikes were already really expensive, which is not the case at the moment. So,
and they were really expensive because of the huge need to unwind a lot of risk capital in the trade. For sure, the 7 was going to get taken out, and actually, the 9 then became really kind of possible as you imagine this huge unwind. Whereas today we don't have that unwind. It's a sleeping dormant market. It's a well-behaved market. There's no complacency that has to be shaken out.
Yeah, it's more difficult because the leverage is not embedded in the currency directly. It's internal rather than external, and so it's like the currency is still a release valve, but it's not where the leverage will explode.
Is there? And do you want to pick one final expression?
Yeah, okay. The Chinese government has taken down EduTech. They've taken down the Macau casinos because, in much the same way it's seen as like negative from a societal point of view. Taken down all the gaming stocks, again, because they see it as negative from a societal point of view. Not the Chinese way. They don't behave in the Chinese way. And so they're basically they're trying to change the culture away from sort of things which they see as suboptimal behavior towards sort of more cohesive behavior. And another thing which hasn't been hurt at all, which I think may be hurt, is the luxury goods sector, which is mainly listed in Europe. It's mainly overseas. So this is a part of Chinese imports, as opposed to something which is made in China, and so it's directly accessible in the West. If you look at Hermes, LVMH, a lot of these luxury goods companies listed in Europe, they derive a significant portion of their revenue from China, and an even bigger proportion of their profits in China, simply because they generally charge more in China than they do elsewhere.
How would they do that, Tom? Because, as you say, these are foreign-owned entities, so it's a little bit harder than putting Jack Ma under the cosh, so to speak.
I don't know, but generally speaking, in China, if they start to make public statements against these companies, the market will start to reprice the stocks.
Yeah.
I don't know. It could.
No, I like that. I like that trade. So I was glimpsing at it when you were talking. This is a short LVMH because I believe it's now the most valuable European stock, and these things change. At the end of the 1990s, Nokia was the largest company, I think, briefly in the world, but certainly by multiples of anything else in Europe. Today it's LVMH. This is 10 years, and you've gone through the bases. The scale is 1 to 7. There've been 7 baggers in 10 years, and it's a re-rating, and the re-rating is on basically the silk purse of the Chinese. The only issue, and so for people who perhaps might not be aware of my style, you don't short things going up, you short things going down, and so for me, entering a trade like that, I would have to I would say, I'd look at shorter terms. So let's look at the last 2 years, and I'd want to short new lows. So like below 600, I'd be like, oh, Tom's kind of beginning to get. I would look for a confirmation of strangers. Here we are. We may as well be talking to ourselves. But trade 600, trades 580, trades 520. I'm like, oh, then you've got a new trend. But conceptually, I really And of course, there's conceptually, I'm really drawn to that.
Yeah, I just imagine that, you know, it's potentially the next shoe to drop, and they're trading at all-time high valuations. So
yeah, I like it. Okay, well, I'm going to wrap. Let me see. We're done.